So 13 years have now passed since the launch of Bitcoin, which is to date the largest cryptocurrency by market cap. These last years have seen a significant increase in the number of cryptocurrencies in circulation, as well as the growing number of crypto service providers. The rise of cryptocurrencies, however, has also led to their use for money laundering and the financing of terrorism. So during this presentation, we will be delving into some of the AML challenges that are faced by operators when dealing with virtual currencies. Perfect. Okay. So initial coin offerings, which are often termed as ICOs, became an increasingly popular investment vehicle for startups because they were shut out by traditional venture capital channels, and they were seen as an option that was not bogged down by the same level of regulation as traditional securities. An ICO is pretty much the equivalent of an IPO in cryptocurrency terms. Unfortunately, the rise of these ICOs came with additional risks, particularly because they were being used as a vehicle for money laundering and the funding of terrorism. This was primarily because they were not regulated, and so they were seen as a very useful tool by criminals, basically. By blindly redeeming cryptocurrency for tokens, ICO issuers would potentially be swapping cryptocurrency, legitimate cryptocurrency, for other types of tokens that originated from illicit activity. And they would then be sold for traditional currency. So you would have a mixture of legitimate tokens, legitimate funds being mixed with tokens or funds obtained illegitimately. The lack of record keeping in these ICOs, together with the large sums involved and the speed at which they occur on the blockchain, make them an attractive money laundering vehicle, especially for the proceeds of cybercrime. Europol has highlighted that the use of cryptocurrencies as a part of criminal schemes is increasing, particularly as criminals have also become more sophisticated in their use of cryptocurrencies. In addition to using cryptocurrencies to conceal money flows as part of increasingly complex money laundering schemes, cryptocurrencies are increasingly used by criminals as a means of payment or as an investment fraud currency. The UK FCA has in fact warned that a significantly high number of cryptocurrency firms that were seeking to be licensed in the UK had failed the test because only 13% of those applicants met the standards set by the EU's 5th AML Directive. So although over these last years we have seen an increasing number of operators in this sphere, however, unfortunately, AML CFT is not being taken seriously enough. Change slide, please. So we are now going to look at some techniques that are used in the crypto sphere to mask transactions. Structuring is a pretty common concept under AML. We're all pretty much aware of it. It involves breaking down a transaction into smaller amounts to remain below AML thresholds. This is also a technique that is commonly used with cryptocurrencies. One criminal network was in fact found to have collected large sums from various criminal groups. They converted the traditional currencies, which we call fiat currencies, on crypto to crypto exchanges, and then transferred those cryptocurrencies to the wallet of another criminal organization. This is why it is important to ensure that crypto exchanges are deemed to be subject persons for AML purposes. Next slide. We also have the presence of what we call crypto mixers or crypto tumblers. The terms are used interchangeably. This type of software program helps confuse the trail of crypto transactions by associating unrelated funds together using various methods. So one of the main advantages of using the blockchain is having a constant trail which cannot be altered of all the transactions that are taking place. However, we still find the presence of these types of programs that try to confuse this trail. So if an address's anonymity has been compromised, the funds can be cleaned using a tumbler. So to give you an example of this method, let's say a criminal purchases Bitcoin with fiat currency, with traditional currencies from a known exchange. This would be traceable on the blockchain because Bitcoin is deemed to be pseudo-anonymous. We'll come to that in a bit. To hide the trail, mixing software is used. The Bitcoins are mixed with other Bitcoins from other users in a pool. The coins are then sent to a mixing software, and the software sends these out to different addresses. The US Department of Treasury has, in fact, just earlier this month banned Americans from using the service of cryptocurrency mixer called Tornado Cash because it was being used to launder the proceeds of cybercrimes. Tornado Cash repeatedly failed to impose effective controls to stop the laundering of funds for malicious cyber actors, and it was found to lack basic measures to address its risks. Next slide. As I was saying, Bitcoin is not completely anonymous. On the one hand, we have the blockchain, which shows how many Bitcoins were sent from which address and when. On the other hand, without any additional information, it is impossible to connect a Bitcoin address to a real-life identity. So Bitcoin is considered to be pseudo-anonymous. Most cryptocurrencies we find are in fact pseudo-anonymous, meaning that they are not truly anonymous because anyone can verify the chain of transactions on the basis of the public ledger. At first glance, nothing in the system connects Bitcoins to individuals. However, this anonymous character is far from absolute. It is technically feasible, though to be fair, it is complex and costly, to identify the parties behind a Bitcoin transaction by bringing together factors that accompany such transaction. This essentially makes Bitcoin a pseudo-anonymous coin. Coins which identify as anonymous are not traceable or linkable through the blockchain's transaction history. Next slide. This brings us to privacy coins. Privacy coins are cryptocurrencies that preserve anonymity by obscuring the flow of money across their networks. And so they make it difficult to work out who sent what to whom. Monero is a prime example of privacy coins and one of the topmost coins for the last couple of years. Monero obscures the three parts of any transaction. The sender is hidden through the use of what are known as ring signatures. The amount sent is hidden through a technique called ring CT, and the receiver is also hidden through the use of stealth addresses. So ring signatures, which are used by Monero to hide the sender, mix a user's account keys with public keys, and they create a ring of possible signers, meaning that outside observers cannot link a signature to one specific user. Stealth addresses, on the other hand, which are used to hide the receiver, are randomly generated one-time addresses, which are created for each transaction made by the sender on behalf of the recipient. All the payments sent to the recipient are routed through these addresses, ensuring there are no links on the blockchain between the senders and the recipient's address. Ring CT, on the other hand, which is used in order to hide the amount that is being transacted. So without the use of this ring CT, the original sender of the coins would still be able to trace the coins if they are moved by the recipient by identifying outputs on the blockchain. Ring CT, however, masks these outputs, making the transaction entirely untraceable. And in fact, most jurisdictions that are moving to regulate cryptocurrencies, the issue of cryptocurrencies, as well as crypto service providers, are also limiting heavily the use of these types of privacy coins. Other popular privacy coins include Dash, Zcoin, Beam, and obviously there are a whole host of types of privacy coins. Next slide, please. So these different challenges and risks bring to light the importance of implementing effective regulation, and I'm going to swiftly walk you through a bit what has been happening on our side of the world, and particularly in Malta, which enacted specific crypto legislation back in 2018. Next slide, please. So the EU's fifth AML directive was formally adopted in 2018, and it was the EU's first formal attempt at regulating virtual currencies and virtual currency-related activities. The directive covers crypto to fiat exchanges, so exchanges that convert cryptocurrencies to traditional currencies and vice versa, and custodian wallet providers. And these are thus deemed to be subject persons for AML purposes. The directive defines the term virtual currency, as you can see, as a digital representation of value that is not issued or guaranteed by a central bank or a public authority. It is not necessarily attached to a legally established currency and does not possess a legal status of currency or money, but it is accepted by natural legal persons as a means of exchange, which can be transferred, stored, and traded electronically. Is this definition sufficient? Almost all cryptocurrencies fit within this definition. They are a digital representation of value, which is not issued or guaranteed by a central bank or public authority. It is typically not attached to a legally established currency. It does not possess the legal status of currency or money, and it is electronically transferable, storable, and tradable. The only point of contention to this definition is that to qualify as a virtual currency, the token must be a means of exchange. This means that it should be used to facilitate the sale or purchase of goods between parties and represent the standard of value accepted between parties. The Maltese definition does not limit it to only be a medium of exchange. Now, the majority of cryptocurrencies that we see are, in fact, the main intention behind them is exactly that, to facilitate the sale or purchase of goods. Bitcoin, for example, was intended to be exactly that. But over these last years, we have seen obviously advancements in technology and different types of tokens crop up, which obviously can all have potential AML CFT risks associated with them. So regulators are now looking beyond what we used to think was the traditional cryptocurrency to make sure that, all risks are being assessed accordingly. Next slide. The FATF also came up with its own definition of what is a virtual asset. So a virtual asset, according to the FATF, is a digital representation of value that can be digitally traded or transferred and can be used for payment or investment purposes. As we have seen, especially over these last years, a lot of investors are using cryptocurrencies, not really for the way that they were always intended to be used as a means of payment, but for investment purposes. So I think it's quite important to consider that aspect as well. Virtual assets do not include digital representations of fiat currencies, securities, and other financial assets that are already covered elsewhere in the FATF recommendations. This is a more general definition when compared to the definition of virtual currency under the 5th AML Directive. However, it also specifies that when we're looking at cryptocurrencies that have security undertones, what we typically call security tokens, these should not be regulated under this definition of virtual asset, but should continue to be defined under the traditional terms that were previously in the FATF's recommendations. Next slide, please. So there's also the definition of a virtual asset service provider. Now, this mainly covers crypto to fiat and fiat to crypto exchanges, crypto to crypto exchanges, the transfers of virtual assets, safekeeping and/or the administration of virtual assets or instruments enabling control over virtual assets, and participation in and provision of financial services related to an issuer's offer and/or the sale of a virtual asset. What regulators have aim to do, this was done in Malta and is also being done at EU level, is that we take the traditional services that we're used to under the financial service industry and we transpose them under the cryptocurrency regime, because in essence that is what is really happening. It's just the underlying security or instrument that changes. Next slide. So as I mentioned, in 2018, Malta enacted its own cryptocurrencies licensing regime, and we call this the VFA framework. VFA is a term that the Maltese regulator created to define a particular type of crypto asset, but basically the definition matches both the FATF definition as well as that under the 5th AML Directive, bar some minor changes. So the introduction of the VFA framework brought with it the implementation of specific AML rules applicable to the VFA sector. In fact, Malta was the first EU member state to enact specific AML rules with regards to trading and the issuing of cryptocurrencies. Under the Maltese regime, whoever issues a VFA to the public, so whoever conducts an ICO, as well as crypto service providers, are deemed to be subject persons for AML purposes. Next slide, please. So just a very, very basic highlights of what our AML rules require. So operators are required to review their business risk assessment every 6 months and to implement any changes as needed. And apart from the standard identification and verification requirements, which are basic for all subject persons, service providers who send or receive VFAs, cryptocurrencies, are also required to collect and retain on file the address from which the VFAs are to be received or to which they are to be sent. The service provider must also ask the customer whether the address relates to a private wallet, a multi-signature wallet, or a custodial wallet. The reason is that private wallets tend to be linked more towards the funding of terrorism and money laundering. The service provider must run checks on that wallet address and, where available, use DLT analytical tools to detect potentially fraudulent transactions and other suspicious activity. Over these last years, because of the highlighted importance of AML CFT, we have seen different service providers coming up with types of digital tools in order to assess these service providers. Next slide, please. The rules also outline the type of transaction records that must be kept to allow the tracing from where funds were received and or where they are to be sent. The following details must therefore be kept. So we have the customer's identification details, the name of any other party to the transaction, details of the bank account or wallet address used for the transfer of VFAs and or traditional currencies. If we have custodial wallets, the name of the institution which is holding the funds, the value date and the date of the value transfer, and the type and value of the cryptocurrency involved. Next slide. The Maltese AML rules, excuse me. The Maltese AML rules also highlight a number of red flags that these subject persons should look out for. Some of the common red flags are that the customer provides inconsistent, misleading, or false information or documentation. There is adverse media on the customer, the funds being deposited are held in unstable or high-risk jurisdictions, or the customer is involved in illicit activities. I think these are quite standard red flags. Next slide. However, some other red flags to look out for are, for example, when the customer largely uses privacy coins, as we've mentioned, or the customer opens more than one account for the same VFA without providing any reason for doing so, or cases where the funds are received from or transferred to an address with direct or indirect links to darknet marketplaces, mixing services or wallets which are associated with illicit activities. There are lists which include these types of wallets. So kind of like when you do sanctions checks, this is pretty much the same thing, but with wallet addresses. Next slide. The FATF also updated its guidance document, which is applicable to the virtual currency sector less than a year ago in 2021. And it identifies a number of risks related to the sector, such as the use of anonymizing and de-anonymizing techniques, as we've seen, and the risk of not having proper oversight tools, including having employees with the necessary level of knowledge and expertise. So although it is obviously, you will always find people who are experienced in the AML CFT sector, however, not all people are necessarily knowledgeable with regards to particular techniques and technologies that are involved in the cryptocurrency sphere. The document, the FATF guidance, also provides further guidance on how FATF standards apply to stablecoins and NFTs, which are different types of cryptocurrencies, the licensing and registration of service providers, the implementation of the travel rule, which we'll see in the next slide, and the risks that are faced by peer-to-peer transactions. Next slide, please. So the travel rule was originally recommended by the FATF, and the EU has also agreed on a law which extends the travel rule to crypto assets transfers. So once this new law comes into force, crypto service providers that are licensed in the European Union will be required to send or receive crypto assets. Those service providers that send or receive crypto asset transfers on behalf of customer, they will be required to obtain and submit information on the transaction's originator as well as the beneficiary. In this case, the regulator has agreed that there will be no de minimis threshold, and because of crypto asset specific characteristics and the risk profile, the information obligation will therefore apply to all crypto assets transfers regardless of the transfer value. Service providers.
Cherise, if you could.
Yes, I'm wrapping up. It's just my last slide to go, and I will wrap up.
Excellent. Excellent.
So, service providers will also be expected to obtain information on the source and destination of crypto assets involved in a transfer. My last slide. Next slide, please. Thank you. Perfect. So my last 2 points with regards to what is next are 2. So we have the Anti-Money Laundering Authority, which is being launched in the European Union next year, and it is expected to be operational by 2024. The idea behind this authority is that it will harmonize and coordinate supervisory practices in the EU, for both the financial and the non-financial sector. My last point is with regards to the EU's proposed markets in crypto assets regulation, which will be the main harmonized body of legislation in the European Union for crypto assets and crypto asset service providers. It is a huge body of legislation, which we hope will help to ensure a balanced playing field across all the European Union, and it will also benefit service providers by offering the concept of passporting, which we already have under traditional financial service legislation. That brings me to the end of my presentation. Thank you.